In this recording, we're going to look at Summer 18 Question 1. Particularly, we're looking at Part A, focused on company valuations. So for 13 marks, you're asked to advise Jane O'Neill whether the matrix have made a fair offer for Thermal. So there's a bit of mergers and acquisitions thrown in as well. Asset valuation, free cash flow, so two methods. And watch, don't lose out on easy marks. You're also asked with three other relevant factors and make a final decision. So you're probably talking 3-4 marks for asset valuation. You're probably talking 6 or 7 marks for free cash flow, and maybe 3 marks overall, 2 or 3 marks for these. So narrative is important, but it's important, of course, you know your calculations as well. So we'll come back up here and have a read of the requirements, or the background text. So O'Neill is an engineering company. The main owner had passed away, and he left the shares to his 3 children, who all own a third each, along with €1 million in cash. So there was a new CEO, Alf Johnson, hired. 2 of the brothers are not interested and they want to sell the company, but Jane, the sister, is possibly interested in taking it over, but she wants to know more about the company. So again, one part of the requirement is, if you look down, you'll be asked to assess the working capital, but the other one is, well, what's the value of the company? Because Alf Johnson has been approached by his former employer, so that's important matrix, to see can they take over Thermal. And they've offered to buy out all the 3 children, 100% of the equity, and they'll give you that offer in Appendix 1. And Mr. Johnson said, it's very attractive, should be accepted, and you shouldn't look for any other offers. So Jane, on the other hand, has spoken to her financial advisor and said there is a possible other transaction where she repurchases 60% of her brother's shares by getting a loan in the company, so a share repurchase, and then she will personally buy the remaining 40% of their holdings through her $1 million in cash. So she'll borrow 8% in the company to repurchase a share buyback, and she'll buy the rest of the shares from her brothers at $1 million. And they said they're happy to sell those shares at that price. So the guys will be getting, the 2 brothers will be getting $2.5 million for their 2/3 share, 66.6%. So it is important to know the background of the question to what you're being asked for. The context of this valuation now is, should we accept the offer or not? Should Thermal accept it, or should they look at an alternative structure? So you said here, you're given your requirement of company valuation. There was another part that you look at your own in terms of working capital. You're asked about significant risks, and then there's an ethical issue as well. So see, can you spot that as you go through? We're just focused really here on requirement A. So you're then given the financial statements. So you can see it is a profitable company, but it's declining profitability the last 3 years. And your forecast is lower profits again this year. And you can see then in the financial statements, it has a small bit of cash, but declining. Significant increase in property. And you can see down here, it has about 2 million of debt. So non-current liabilities would be what we call debt here. And then the examiner, to be fair to them, they do compartmentalize. They tell you what the offer is, and we'll talk through it. They give you the information for the asset approach. So we know we need a statement of financial position to do the asset method, and we have it. And we need extra notes to the accounts. So we'll deal with them as well. And for the free cash flow, we need information about the cash flow forecasts, and we need information about the discount rate. And we'll come and we'll look at those as well. So the first thing is the offer, 3.6 million for all the equity in Thermal. But this is linking in now to Strategic Finance Session 4 about mergers and acquisitions. Only 80% is paid up front. So 3.6 at 80%. There's only 2.8 million in cash. The other 20% will be paid 10% each year if net profit grows by 10%. And Alf Johnson will be retained as CEO and given equity shareholding, but that's not disclosed. So again, a good student will notice there's your ethical issue. Alf Johnson has a conflict of interest. He's pushing the deal to go through. If you look back up here, he's pushing the deal to go through, and he's saying don't go and look for other bidders. But he hasn't disclosed, as we found out down here, that actually he's going to be the new CEO of this business, and he's going to get some free equity. So he's clearly biased. So that's the ethical issue. So you shouldn't be taking advice from Alf. You should be taking advice from independent advisors. So see, did you spot that as you went through? So the asset valuation, then they give us information about bad debts, about the non-current liabilities, and about the short-term investments. So they're just updating the information that's already in the financial statements. So we'll go through each of those in a second. And likewise, they give us information about forecasting cash flows and the relevant discount rates. So we're not too worried about working capital. That's for your part B. You'll do a small bit of financial analysis. So your first part then is to set up the question for part A. Similar to risk management, we put the answer. So you put a nice little answer table, the value using net asset and the value using free cash flow. And you reference there working 1 and working 2. So we have only 2 methods here, so it's a nice short table. But the key point is leave your finished table there, leave a couple of lines underneath for the commentary and the conclusion, and then go to your workings. So it just looks professional to the examiner how you approach it. Now remember, in the exam, you should have cheat sheets for each of the methods in company valuation. The asset method, price earnings method, dividend yield, free cash flow, and the dividend valuation model. There's only 5 methods, so and because it's open book exam, you can kind of help by having a cheat sheet there if it comes up in the day of the exam. And company valuations are quite popular, particularly in question 1. Your starting point here is always the book value. Book value of equity in the statement of financial position. Note, you'll see in some suggested solutions, they will restate the whole statement of financial position. There's no need here. You can do it like this and you'll get your full marks as well. So there's no need to restate the whole statement of financial position. It often takes too much time and you're going to get very little benefit from it. So we'll use the 2018 here, the most recent one. The book value of equity is share capital plus retained earnings. It is not the 6 million, because that includes liabilities. It is 3250. And then you go down through the notes. There's no goodwill there, because if there was goodwill, you would always take it out, but there isn't. So when you come down here, then you're told 80,000 of trade receivables is owed by a customer in receivership. They will only recover 10%. So that means you have here bad debts. So be careful. The 80,000 is already in there. So what you're doing is you're taking off the 90%. Minus 80, because we're dropping the last 3 zeros, times 0.9. So 72 is been written off as bad debts. So we'll just tidy that up. So 72. So that's your first adjustment. You're just updating what's given in the question. You're told 290,000 of non-current liabilities, i.e. debt, can be redeemed in exchange for 230. So that means your liabilities are going down, which means your equity is going up. So we'll call that non-current liabilities. That is plus 60. Because that means your liability will go from 290 to 230, means your equity goes up by 60. And finally, then you're told your short-term investments, which you have up here, they are in at 30,000. They are 5,000 shares in a company. Notice the way they don't give you the price directly. Little a trick by the examiner. The earning per share is 96 cents. And the price earnings ratio is 8.3. You should know from your ratios, to get the price, it's earnings per share times the PE ratio. So the share price here is 7.968. So the market value of these shares is 7.968 times 5,000. So 39,840. So 39840. And if you look in the question, as we said, it's in there at 30,000. So that's an uplift of 9,840. So that's your short-term investments. Plus 9.84, we're just going to round to 10. So 9.84 rounded to 10. There's no problem with that. And you'll even see in the suggested solution, they round to keep it neat. It's not going to make a difference about 600 euro there, or whatever it is. That's going to be fine, as long as you show where the working came from. So you calculate the updated value. Don't put the full amount in, because the 30 is already in there. That's part of the 3250. You only recognize the increase. And that's your asset value done. So the asset value is the one I always start with. So your net asset value there, 3.2 million. And remember, often the net asset approach is always going to give you the lowest value, because the net asset method, which you should have in your cheat sheet, its concept of value is break up the business today, sell the assets, pay the liabilities. That's what you're left with. So it ignores the future earnings potential of the business. So it's often seen as a floor to the valuation, and there can be higher ones. But that's one of them done. Said you're probably only looking at about 3 marks there, much more marks going for free cash flow, which we'll go to in working 2. So in free cash flows, you need 2 things. You need to forecast your cash flows, and you need an appropriate discount rate. And again, you should have looked in the question in your cheat sheet, should I say, and have that ready to go. So we're told here, Thermal invests an average of 15% of turnover every year in additional non-current assets and working capital. So they keep them together, 15% of turnover. This will be maintained in the future. The financial advisors expect the long-term growth rate to be 1.5%. Now, usually what we have in questions, we have what we call a 2-stage free cash flow, where you might have individual forecasts for a couple of years, and then you start the long-term growth rate. What was unusual about this question is there's only one growth rate, and it starts straight away. So instead of a 2-stage valuation, like you might see in previous questions, there's only 1 stage here. This says it's a perpetuity straight away, 1.5% growth. So instead of having to do 2-stage where we do an individual forecast for the first couple of years and then do the terminal value at the end, we can do the terminal value straight away here. So we need to figure out what the free cash flow in 2018 is. Right? So your starting point then is your net profit after tax. So your net profit after tax here is, just be careful, 495. You add back your depreciation, you add back your interest. Depreciation is non-cash, add back 490. You add back interest because we're looking at free cash flows to the firm. So you always add back your interest. We're looking at free cash flows available to debt and equity. Remember, because we've taken after tax, tax is already taken off, so you don't double count it. And then we take off our investment, which we're told is 15% of turnover. So that is going to be a negative, because that's a drain on cash flow. 15% of 4796 times 0.15. So 719 is your, what we call capital investment, but also working capital. And that means your, just put here, FCFF. What that stands for is the free cash flow to the firm. That's available to debt plus equity holders. So remember, that's the thing we would have covered in class. You can either do free cash flow to the firm by adding back interest, or you can do free cash flow to equity. But when we do now our discount rate, we must use WACC. Because if you're using free cash flow to the firm, you must use the firm's discount rate, which will be your weighted average cost of capital. If you're using free cash flow to equity, the cost of equity will be fine. So there's an extra step there. That's where the marks are coming, your knowledge of Cap 1 finance as well. So what we have to look at then, let's calculate the WACC. We have to look at debt and we have to look at equity. Now, usually we use the market value here for debt and equity, but we don't actually have it. So for example, for debt, there's no market value. All we have is 1938 in your non-current liabilities. So that's going to go in there, 1938. And your equity, you have the book value if you wanted to use it here. We're just going to use the book value. It doesn't really change too much, 3250, coming from the statement of financial position. So there is a bit of an estimation going on. And that means the weight here, total value is 5188. So put that over and put that as a percentage. So we'll see here, you have 37% debt, 63% equity. And that gets you the weight overall of 100%. So you see, it wasn't clear in the question you had to do WACC. You had to know from your free cash flow approach in your cheat sheet, If I'm adding back interest, I have to use the firm discount rate. The cost here, the cost of debt we're not told, but we are told in the question, or you're using the other information that's given in the question. The cost of debt for new debt is 8%. And that's why you're told in the question here, if the company goes to borrow, they can borrow 1.5 million and Thermal's bank lends at an interest rate of 8%. Now, of course, you have to adjust that for tax. So if you want to adjust it downwards, you're going to multiply by 1 minus t. Right? So you get the after-tax cost of debt. And they tell you the tax rate here. So see the way you're using all the information in the question. Tax, it's given somewhere. Don't know if it's referenced. Just double check back. So they don't mention a tax rate here. I can't see it anyway. So what you can use is 12.5%, because that's the normal tax rate to use in Ireland. But again, it's personal preference. You could put in 20% as long as you put in some tax rate. It's not obvious there that it's shown. So you're saying there the 0.08 times 0.1 minus 0.125. So you're saying the after-tax cost of debt will be 0.7% or 0.07, which is 7%. The equity, well, they give us information in the question to say beta is 1.6, risk-free rate, the tax rate is there. Let me look around first. Beta is 1.6, risk-free rate is 0.75, and be careful, the market risk premium is 6%. The market risk premium is RM minus RF. So don't take off RF twice, it's already done for you. So cost of equity, 0.0075 plus 1.6 times 0.06. So your cost of equity there, if we bring out the decimals, 10.35%. And then to get your WACC, it's the weight times the cost and the weight times the cost. And that means your WACC here in and around 9.1%. So that was a bit of work there to see could you get your WACC. You have to figure out what debt figure do you use. You have to get the weightings. You have to calculate the after-tax cost of debt. And you have to calculate the cost of equity using CAPM. So it's very easy, embed a lot of CAP 1 finance, weighted average cost of capital, in a CAP 2 question. So cost of equity there is 10.35. The WACC is 9.1. So that we have our cash flow. We have our discount rate. Usually what you'd see in class would be, we do a couple of years, the forecast period, and then after that we'd say in orange, that'd be the horizon period, when the long-term growth rate kicks in. Actually, in this situation, the long-term growth rate kicks in straight away. So what they're telling you is, this cash flow is a perpetuity with growth, and the growth rate is 1.5%. So it's actually deceptively easier than students would have been used to before, which caused students a bit of an issue. So what your formula is then, the P0, the value today is going to be 421 times 1.015. So the current cash flow times 1 plus G divided by 0.091 minus 0.015. So cash flow today times 1 plus G over R minus G. R being in this case your cost of capital, the weighted average cost of capital. So doing that out, gets you 5623. In and around that is fine, but be careful now, that is called your enterprise value, meaning that is debt plus equity. Now we're just being consistent here. We're taking cash flows available to debt and equity. We're using the discount rate of the weighted average of debt and equity, which means you're going to get the value of debt and equity. And you take off debt then to get the equity value, because remember that is what they're looking to buy. So minus 1938, your equity value then is somewhere around 3.6 million. So as long as you get somewhere around there, you'll get your marks. So there is a lot there. Deceptively short, or deceptively simple and short here. but there's a lot of knowledge of Cap 1 finance going on. So you need to make sure you know the basics around WACC. You need the basics around how to get the present value of a perpetuity. So that's what we call often valuing the terminal value. We use that formula. It's just a simpler question in 2018 where the terminal value could have been done straight away. Usually we have to do a couple of individual cash flows before we go on. That's what we call the two-stage model, whereas here we had a one-stage. So take the 3685 and put it into your nice neat table. So think about it now. The first thing the examiner will see when they start the question is the answer. And you'll cross-reference your workings in. And now you're going to make your conclusion based on what they ask you. So if you go back up, they're asking you 3 other relevant factors and make a final recommendation. Alright, so there's plenty of points you can make here, but the key point is keep it relevant to the facts of the case. Have the company been made a fair offer? Well, the first thing we've seen, if we go back to it, is the offer is not 3.6 million cash. It's only 2.88 million. So the first point I'd make is offer is only 2.88 million cash and possibly another 20% based on future profits. So we're saying they're only offering 2.8 million cash today, and that means next year's profit and the year after have to grow by 10% each year. But they're currently declining. So there's a low chance of that. And remember, this is what we call a buyout or an earn-out clause. That usually makes sense when the managers are staying in the business. But this offer means that the managers, in terms of the 3 siblings, they would leave the business. So they'd have no control over profits. So it's very unlikely it would ever be met. Because what would Matrix do is they would depress profits for the first 2 years, so they wouldn't have to pay the last 20%. So your first key point is the offer is well below the valuations above. Even the net asset value, it's below it. You can't say the 3.6 million is the right one because you're probably never going to get 3.6. You're only ever going to get the 2.88. The offer from Jane could be more valuable to the brothers and allow Jane to remain in the business. So remember, there is another offer on the table they should be considering. And that is the transaction that Jane has suggested. And a good student will use the numbers. The numbers are given for a reason here. Jane is on about giving them 1.5 million from the company that they would borrow and 1 million of her own. So for their 66% share, so under Jane's offer, for their 66.6%, they will get 2.5 million. In the Matrix offer, the 2 brothers, for their 66.6% share, they're going to get 2.88 million, which we kind of figured out was the effective offer, times 0.6666. So they're only going to get 1.92 million. So Jane's offer looks more financially attractive. So unless Matrix are going to come back and they're going to give a better offer, it may be better off looking for Jane. So the third thing then is, another relevant factor is, does Jane want to stay in the business? And that's a relevant factor because if she wants to stay in the business, it makes a lot more sense to try and do this transaction because the brothers will be better off as well. If she doesn't, well, maybe you should go and look for other buyers. So a fourth point could be, need to look at other buyers, not just Matrix. Keep options plus negotiating power open. So just because Alf said, what was his name? Alf Johnson said, don't attract other buyers. We know he's a conflict of interest, and that's an ethical issue. So one of your recommendations should be, this is a one offer from one company. You should be looking at other offers. If you do want to sell it all out, because Jane doesn't want to stay in the business, well then make sure you go and look at, see who else might bid on the business. Don't just take the first offer that appears. So your recommendation will be here, do not accept the offer in its current form. Now, if they change the offer and they maybe offer you 3.6 million cash up front, then it might be different. But as it's currently structured, that other 20% is most likely never going to come the way it's set up. So you're really just getting an effective offer of 2.88, which is well below the valuation. So that was a very good question that linked in ethics, i.e. the part D. You're linking in risk as well and financial analysis that you'll have to go back and have a look at part B and C. Very good question covering a lot of strategic finance, and a lot of it came from Cap 1 finance as well. The WACC here, the ratio analysis here, and the bit of ethics would have all been covered in Cap 1 finance or the equivalent in your undergrad degree.